Hello and welcome, Form 4 students. Today we're going to learn about account classification and the accounting equation, important basics in accounting principles. Imagine you're running a small store. Every transaction needs to be recorded in the right account category. Account classification helps us organize financial information in a systematic way so we know the financial health of the business. Without classification, information gets mixed up and it's hard to figure out profit or loss. We'll also get to know the basic accounting equation: assets, charged liabilities, plus owner's equity. This equation must always be balanced. Every transaction affects at least two accounts. This is the foundation for understanding and preparing accurate financial reports. There are 5 main elements in account classification: assets, liabilities, owner's equity, revenue, and expenses. Assets are economic resources owned by the business, like cash, vehicles, and inventory. Liabilities are debts or financial obligations to outside parties, such as bank loans and accounts payable. Owner's equity is the owner's claim on assets after liabilities are deducted, the capital invested and accumulated profits. Revenue is income from sales or services, while expenses are the cost to generate that revenue, like salaries, rent, and utilities. Every transaction will be categorized into one of these 5 groups. The difference between total revenue and expenses determines the business's profit or loss. Correct classification ensures financial reports are accurate and reliable. This is the basis for evaluating a company's performance and financial position. Understand each of these elements to master accounting. The basic accounting equation: assets, DAX, liabilities. Plus owner's equity is the key to the accounting system. Every asset is financed either through debt, liabilities, or owner investment, equity. This equation must always be balanced after every transaction. For example, if the owner invests our $20,000, both assets, cash, and owner's equity increase by our $20,000. If the business buys a computer for our $3,000 on credit, both assets, equipment, and liabilities, accounts payable, increase by $3,000. Every change must maintain the balance of the equation. This is the basis of double-entry bookkeeping. Every transaction has 2 effects of equal value. This balance ensures financial records are accurate and complete. Understand this logic to detect errors and maintain data integrity. Besides the 5 main elements, there are contra accounts like sales returns and purchase returns. Contra accounts reduce the balance of their main account, giving more detailed information in financial statements. Sales returns record goods returned by customers, while purchase returns are for goods returned to suppliers. This helps analyze performance and product quality. Another important tool is the chart of accounts, a systematic list of all business accounts, each with a unique code number. The chart of accounts makes it easier to find, classify, and record transactions, especially in computerized systems. Numbering usually follows the groups: assets, liabilities, equity, revenue, and expenses. This structure makes the accounting process more efficient and organized. Mastering account classification and the accounting equation is fundamental for preparing accurate financial reports. These reports are crucial for owners, managers, investors, and banks to make decisions. Classification errors can lead to incorrect information and unwise decisions. The accounting equation instills discipline by ensuring every record is balanced and complete. Contra accounts and the chart of accounts help with financial data analysis and management. Master these basics to make learning subsequent accounting topics easier. This is the first step to becoming a successful entrepreneur or accountant.